morning, traders. So, welcome you all to this wonderful webinar on intraday trading strategies using order flow by our master mentor, Mr. Rajandran from Marketcalls. Quick intro about Mr. Rajandran. Mr. Rajandran is been associated with Bell TPO for more than a decade now. He's been instrumental in creating a innovative method of trading using market profile and order flow. Most of the alerts you see in our indicators are all contribution by Mr. Rajendran, and his contribution as far as market profile is concerned, it's tremendous. He's trained several traders on market profile and order flow since 2015. So he's in to this market profile training programs, and every quarterly he does a program dedicated for market profile and order flow. He has a course called Trade Edge. So probably Rajendran would discuss more about that during this session, right? So today, of course, all our BellTPO clients who are with us today, definitely it's going to be a really exciting session where now, Rajendran would be discussing on the intraday trading strategies with some recent examples, so that some of you might find it very interesting, or some of you might find it new, but nevertheless, we'll make sure that I think Rajendran will make sure that even beginners should be able to understand the concept of order flow. So without further delay, let's get started, guys. So let me hand over the session to Mr. Rajendran. Over to Rajendran.
Thank you, Vinod. Thank you for the wonderful info. Wonderful introduction. And thank you for arranging this session on this Saturday. And thank you guys for being there on this Saturday, spending time with us. So in today's session, right, it's going to be a preliminary session on order flow. For those who are very new to order flow, definitely this session will be very much helpful in understanding the very basics of order flow here. Now, what we are going to discuss in today's session is like how you can understand the order flow charts, right? And what is the difference between traditional candlestick charts and order flow, and some of the basic concepts like delta, cumulative delta, stacked momentum. And in fact, at the end, we will be talking about stacked momentum trading strategies. So two different variations that we're going to learn in this specific session. So I hope my audio and video quality is good enough to kickstart. If yes, simply type yes so that we can quickly kickstart with the session. I hope my audio and video is pretty much good. All right, great. Thank you, everyone. So without further delay, let's get into the context over here. So if you ask me why you should use order flow, then I would quote this. Recently, you would have heard about Jane Street. They are moving the markets the way they want to move. So one thing from the Jane Street saga, what we would have learned is indicators probably they don't move the markets. The money, the big money usually move the markets, right? Indicators are merely a derivative of it. What price is doing, indicators are going to do the same thing. In fact, indicators itself nothing but a formula of, if you take any EMA, Bollinger Band, RSI, moving average, super trend, they're nothing but a simple formula which is derived on top of the open, high, low, close at the max volume or open interest, right? So end of the day, what it's going to do is like what price is doing. The indicators also going to do the same thing. So if you want to track the real markets, if you want to get the real context, you want to know what actually the real money is trying to do here, right? Now, that is where the order flow comes in. Order flow provides an X-ray vision to the markets. It gives you a microscopic view within the candlestick charts. You can look inside the candlestick charts, and then you'll be able to bifurcate what buyers are doing separately and sellers are doing separately. Of course, order flow tracks only the executed buy market order and executed sell market order. Whatever the charts that you are seeing in real time. They're nothing but how the traders are moving the price action. See, in a traditional charts, what you will be focusing, like we'll be primarily focusing on price. Maybe at the max we can focus on the volume. But here we can not only focus on the price action, here also we can track the price action, but combined with that, it gives you a visualization so that you'll be easily able to track the market context, what the market dynamics is doing. It gives you more detailed insights, whereas a traditional candlestick charts gives you very little insights. So the insights could be like when the market could be turning, where your risk is very low, and where the momentum is happening, where the support is happening, where the resistance is happening, where the institutional flow is happening. So a lot of detailed insights the order flow will reveal. Of course, a human has to be in front of the PC and they have to decode it, right? And that is where we are here for, try to uh, bring the basics of order flow. Now, what you can see in the order flow is like you can see the institutional footprints. Typically, a big money activity, where the big money activity is happening, where the traders are getting into trap, support, resistance, and where the market is likely to turn before it's going to happen. And the most important thing, absorption, where the big players are accumulating or maybe even distributing also. So absorption, very clearly you can able to identify from the order flow point of view. Now, why it matters to a trader means, so we've been fighting in this battle without seeing the battlefield, right? So that is what it is happening just by looking into the price action. We are sitting in our dorm room and then we are trying to fight in the dark room. But rather, what order flow will reveal is like what is actually happening in the battlefield between the buyers and sellers. It gives you immense insights about that. And of course, it also gives you an idea about what smart money is doing. And the primary idea of why I've been using order flow is like your end risk will be very much minimized, your returns will be maximized, right? Of course, that's a primary end goal of every trader, and order flow truly does that, right? And you can spot reversals as they form. You can truly understand the market psychology in real time. You'll be able to manage your trading psychology also in real time, which is very, very important. And most important thing, what I haven't put in the PPT is like you will be able to easily able to control your emotions, and you can truly go objective and you can do a systematic visual trading using order flow. So pretty much basics here. In markets, right, we can classify the type of order into active orders and passive orders. See, active orders are the one which is going to move the markets, typically market orders or stop loss market orders. They take the liquidity from the order book, and you can only visualize market order only the order got executed, and then the order is visible on your order flow charts. Any orders which are visual on your order flow charts, they're nothing but market orders only. So buy market order moves the price action up, and sell order creates the market down. So in a simple terms, market orders create price action, right? Whereas limit order, they control the price action. Limit orders are nothing but a pending limit orders. They're not going to move the markets. They're just going to sit in the order book and provide liquidity. They control the velocity of the price action. But you cannot underestimate limit orders, because it is one of the weapon of institutional traders, right? You can even Jane Street, right? They used limit orders as a weapon to bring up to control the markets. And market makers used to provide two-way quotes on a daily basis. Market makers, right? Whoever you are seeing on the order book, they're nothing but most of the time, 80% of the time, they are from the market makers quotes. So which you can see them, they will be providing quotes on both the sides, buy side also, on the sell side also. So here is a traditional example of order flow charts. and also an market depth chart over here. So this is the order book. I'm showing you the top 20 order book. It's a pretty old one, but still it is relevant even in today's session. So what you are seeing is like the bid and ask are here. As the price is moving up, when you are seeing an uptick, when the price is moving up, it is pushed by an buy market order. When the price is pushed down, it is pushed by an sell market order. So continuously, every second, the two-way auction process happens. Market moves up and then comes down, moves up, comes down, moves up, comes down, because buyers and sellers are colliding in the markets against each other. So which side, obviously the market is going to move, whichever the side at that instant, who is placing the market order, that side the market is eventually likely to move in that specific direction, right? As you can see that market keeps on oscillating back and forth. As the price moves up, the buy market order will be taking it from the offer side. When the price pushed down, the sellers will be eating it from the bid side over here. Sellers will be pushing that down, and they will be taking the orders from the order book on the bid side. So buyers interact with sell limit orders, and sellers, if they are pushing the price down, they'll be interacting with the buy market orders. Always a market order interacts with a limit order. That's a very simple terminology that it's applicable across all the exchanges. Now in the order flow, we have like a couple of important terminologies. One of the important terminologies is delta. So delta is nothing but total buyers in that candle side. So you can see like the buyers will be on the right hand side and the sellers will be shown on the left hand side over here. If I add all the buyers on the right hand side minus all the sellers on the left hand side, the resulting number is what we call as a delta. That shows who is in control in that particular candle. So if the delta is negative, you can see that the negative delta minus 503, that's a number here, which means sellers are strongly in control. Whereas if the delta is positive, that means in that specific candle, more buyers participated, more buy market orders participated compared to more sell market orders, right? So which is pretty much visible. Smaller the number, not much of an effect there. Bigger the number, more traders competed, more. You can see like the delta candle itself shows like more bigger sellers, whereas the positive candle shows that more bigger buyers competed compared to the sellers over here. Whereas the cumulative delta is nothing but sum of all the delta right from the session start. So I'm just giving an example here. Imagine we are having a 5-minute charts. I'm having a delta like plus 60 at first 5-minute chart. First 5 minute I'm getting a plus 60 and then plus 45. Third candle I'm getting minus 135 and plus 90 and then it keeps on going on, right? So my cumulative delta, when the market starts, will be at 0, but then slowly my 60 will be added up. Now 45 plus 60 will get added up to 105, and then minus 135 will be added up to my current cumulative delta, which is minus 30. So every delta will be added to the previous delta cumulative delta value, right? So totally I'll be able to get the effective number over here. Now what this number shows is like 935. At 935 I'm getting a total value of plus 150. What does that means is at 930, exactly at 930 or 935, there are 150 more buyers compared to the sellers who participated today, which means buyers are overall in the control of today's market. That's what it means, right? So at any given point in time, maybe you can say like at 9:55 the delta went negative. So what does that mean is at that time the control is shifting from buyers to sellers. That's what it means. So last Friday, if you would have seen continuously, the delta has been negative. Market also keeps on falling and cumulative delta keeps on rising. That's what you would have seen on last Friday. last Friday in Nifty. Maybe later on I'll show the charts if time permits. And here are some of the list of trading strategies that we will be covering in TradeEdge 8.0. Roughly around 25 plus strategies. Most of them are intraday scalping strategies, mostly related to Nifty and Bank Nifty, and some of them we'll be discussing related to equity markets as well, because we've been getting a lot of queries on uh, how I can trade in equity markets, like top heavyweight symbols like Reliance, Infi, HDFC Bank. So those are some of the examples will be added. And this time we've been also including market depth based strategies as well, not just order flow based strategies. Market depth also plays a major role here. So we'll be using 50 depth is what primarily we're going to use. So using the 50 depth, we'll be including, along with that, we'll also include we'll be combining market depth along with order flow. We'll be combining this time so that you can get even more better insights in reading the markets. And of course, if you want more details about TradeEdge 8.0, you can scan the scan code. And a little bit about TradeEdge. TradeEdge, we've been doing it for quite some time now. We are in the 8th version of it. So every time we had improvised the framework. It's a framework which is comprised of market profile, order flow, and volume spread analysis. So basically, market profile, order flow, and volume spread analysis will be implementing for like almost. We'll be teaching it for like almost 45 days of live trainings will be there. I would say like 60% of the content will be from market profile, and 30% will be from order flow, and remaining 10% will be from volume spread analysis. And a lot of techniques will be combining market profile along with order flow as well, right? So it goes hand in hand. Mostly it makes sense for an active traders to come and learn about this, the radical way of understanding the markets and market dynamics. All right, now getting back to the topic. So the stacked imbalance, right? So stacked imbalance is one of the primary thing that we are going to talk about in today's session. A stacked imbalance is like an momentum indication where the momentum is happening in the markets. So what we will be doing is like we'll be comparing the bid volume along with the ask side volume. So bid side volume will be comparing with the ask side volume, similar to this, like kind of a diagonal comparison is what we're going to do here. So on the left hand side, what we will be having, we'll be having a sell side volume. On the right hand side, we'll be having a buy side market orders, which will be collected in bins similar to a market profile, right? So every bin will be having its own size. For example, for Nifty, we'll be using 2-point TPO, and for Bank Nifty, we'll be using 5-point order flow. Every 5-point, we'll be collecting whatever the orders are happening within a 5-point range, we'll be putting in a box. So every box represents a 5-point in Bank Nifty, and every box represents 2-point range. Within that 2-point range, how many orders are getting collected, we put that in a single box. So the comparison we have to do diagonally, because bid and ask are not same price always. If you had seen that top 5 bid and ask or top 1 bid and ask, the bid price and ask price are never be the same. It cannot be the same, right? So the comparison itself we cannot do side by side. It's okay if you are doing a side by side comparison also, but traditionally there is a practice there. People tend to do diagonal comparison, and that makes sense also, right? So this is applicable only when we are comparing how much bigger volumes are happening compared to the buy side versus ask side. When you compare diagonally, wherever you're going to find more than 5 times, 5 times is what generally I prefer to use. So 5 times, so that's what we call as an imbalance. So here in this example, you can say like compared to the buy side, sell side is having more imbalance. How much time imbalance? 11.6 times imbalance here. Likewise, compared to 38, 445 is what we are having, which is again 11.7x times imbalance. And comparatively compared to 32, we are having 125, which is again I mean, comparatively more than 5x imbalance over here. So same thing goes on the downside also. So where you can find like the imbalance multiples are here. Typically, the imbalance multiples are 480, 425, and 108 are comparatively showing a clear imbalance over here, right? So that way you can clearly say that the imbalance are pretty much bigger. So compared to the sell side, buy side is having more imbalance. At least it should be having 5 times of imbalance over here. Now from the order flow chart, right? I'll go and show you from the order flow chart how it looks like. So this is how the order flow chart looks like. So you'll be able to see an imbalance over here. Let me show the last Friday's chart where we had to see an imbalance. So last Friday, if you can see that the price action totally creating an imbalance over here. So wherever you can find this red color zones, when there is 3 consecutive zones are there, minimum 3 consecutive blocks of imbalance. So what we will do, we compare diagonally. So 6 and 30, obviously 30 is bigger. Compared to 0, 16 is bigger. Compared to 0, 62 is bigger. At least it is more than, every case it is more than 5 times bigger. And 5 times is more of a software settings, right? So you can control it. You can, if you want, you can go for 3 times. You can go for 10 times also. Depends upon what exactly you are looking for. I prefer to take an minimum 3 blocks of imbalance. And I do watch imbalance only on a 3-minute time frame, not on any other time frame, right? Because 3-minute time frame, your risk will be very much lower when you are taking a trades. Now here in this example, you can see like the zone, traditionally, most of the times it is going to act like a resistance or support zones. So price is going to enter into the zone and it is going to reject. So whenever the price is going to enter into the zone, you are going to take a trade with a stop loss, probably somewhere just 1 TP above that. Just 1 TP above that. Well, maybe if you are not comfortable, you can go for 1 or 2 TPs above that, but not more than that. So by doing so, your risk will be kept very much tighter, right? So when this is happening, when the price is rejecting, you can take a trade, or when the price is entering into the zone, you can also consider taking a trades as well. Thereby you can reduce the stop loss level as low as, like here the stop loss is like approximately, if you could try to measure it, it is like 6 to 8 points. That's a, so 3 point, right? So 3-point block over here, which means what, how many, so every block is like a 2-point range. So 6 point is the stop loss over here in this case. So maximum it can go up to like 6 to 8, 10 points of stop loss is what primarily you're going to take most of the times. And reward is like what market gives. Reward is not in our control. What we can manage is like only the risk part. What order flow gives you is like it gives you a strong identification zone, and such kind of zone, when the price is entering into the zone, you can use it like a kind of an resistance in this instance, and you can look for some quick trades. Typically a very good risk reward ratio, even and 30 point on the downside, it means a lot, right? 30 point on the downside, you can see like multiple times price is rejecting around that level, exact level, and the price is getting back down. It had done pretty much more than 30 points, but I would say like 30 points is a reasonable expectation with a 6-point stop loss, which is like what, 1:5 kind of risk reward ratio. And not just that, the second time also it happened probably during mid of the day. You can see like prices getting back down, and you can see like prices touching the zone. So here is the stop loss. Probably if you ask me where to keep a stop loss, I'll keep like 1 point TP or higher. Price is touching the zone and it is bouncing back to the downside. Again, your stop loss is, this is your zone here. This is the zone, right? So price is entering into the zone and it is rejecting. All these are happening on Nifty futures on last Friday. Price is rejecting, and that's a trade. Again, if you look into the stop loss, approximately I would say like 8 to 10 points is the stop loss here. 8 to 10 point stop loss with a reasonable downside move, right? Downside move is what you can see here, a classical downside move from 25,030 level. It even went to like 30 points on the downside, which is again still 1:3, but it had done more than that. It went up to like 45 points on the downside. It had went through that. So if you're looking for very quick trading opportunities, right, then stacked imbalance is something that one can immediately start with. Very easy to start, very easy to monitor. The risk is very much tighter. So if you could see this example here, the other example, there is an 11 o'clock price is actually forming an stacked imbalance, like kind of a support zone. Price is entering into the zone, but it is breaking down by one TPO. It's breaking down by one TPO and then it started moving up, right? Of course, it's stop hit, but we can't do anything. But sometimes when you're entering into the trade, your stop loss is going to hit. In that case, the loss maximum, let's say you're going to take a trade over here inside the range, probably your stop loss is going to be max. It will be like what, 4 to 6 points. So if at all any loss, the loss is going to be very minimal. If at all there's going to be any profitability, the profitability is going to be pretty much on the higher side. So it also has a pretty good win rate as well. Now here are some of the examples for stacked momentum, which is acting like a support zone. So where you can see like the stacked momentum zone, price is exactly touching and then it is bouncing back. Not only that, one more stacked momentum zone is forming. Price is touching and then it is bouncing back and it keeps on rallying up. So all these zones are going to be your entry point levels, right? And again, this is another from day before yesterday. So day before yesterday in Nifty, you can see like there is a big broader zone, multiple stretch of stack momentum is what we are seeing here. 1, 2, 3, 4, 5, 6, 7. Of course, even if there is any in between zero zones, that is also will be counted. Zero zones shows lack of liquidity. So basically those levels also will be counting around those levels. You can clearly see that price is entering into the zone and then pulling back up. Again, one more time, it is dipping down deeper and then it's able to pull back, touch down and then pulls back, and it keeps on going up. Now this takes like approximately 15 minutes of holding period. So max to max, your holding period will be, since we are operating on a 5-minute chart, 3-minute charts, right? So your maximum holding period will be ranging anywhere between few minutes to maximum 30 minutes is the holding period for this style of setup. So if somebody is looking for a high quality setup, then stack momentum setup is something they cannot ignore from an intraday perspective. And stack momentum also can also act like a resistance. This exact resistance which happened on last Friday, which we already talked about that. And another exact same setup which happened during around 10 o'clock. So one more resistance, price exactly went to the stack momentum zone, the pink color zone. That's a stack momentum zone, which is acting like a kind of a resistance. Now, if you ask me, will it be acting like a support or resistance all the time? If you ask me, absolutely no. You can also use it like an breakdown setup as well. Whenever it is breaking down, right, then you can also trade the stack momentum breakdown setups also. There are times stack momentum zones will be broken down very hardly. So in such kind of places, you can also play the breakdown setups as well. So many instances you're gonna see stack momentum acting like a support or resistance. Few instances you're gonna see like stack momentum is gonna get broken down and then you're gonna look for an opposite trades, right? And you can also go for the breakdown setups also. But most of the times you will be seeing support and resistance kind of setup on a 3-minute scale. So immediately, if somebody want to start with, they should be start monitoring the Nifty and Bank Nifty charts. So charts we'll be watching only in futures, and the execution you can do it in options. Right? You can do it in whichever the option format you want. If you're an option buyer, you can do option buying. If you're an option seller, yes, you can do option selling also. one thing what I'm gonna try to explain here is like there is also one interesting thing that we've been keep observing here is like market depth. So I'm going to show you some example over here. So this is something in trading dashboard that I had designed. I had designed long back. So it shows the complete market depth up to 50 levels. It's going to show you. It's also available freely. One can download in my GitHub. It's already available. You need a Python to install it. So what you can do with this, like you can also compare with order flow and you can get a better idea about it. So a lot of metrics I've been developing and still upgrading it whenever I feel I should upgrade, whenever I'm finding any new ideas, I'm adding it to it. Now these tools will be pretty much useful to compare with the order flow, to combine with order flow. In fact, you can very soon you can see that last Friday when the market opened, it's like last Friday's market open. When the market really opened, right, what happened on last Friday is like you can see like the buy side is the order book, right? Let me pass it. The buy side is, for me, it is looking weaker, and the sell side is looking very stronger. Now, you know, right? Why the markets are supposed to go down, right? Am I right or not? You can tell me like what is your opinion? Why the market has to go down? See, many people think because there are sellers are more, the market is going to go down, and because the buyers are less, the market has to go on the downside, right? So more than the number of sellers, number of buyers here, 10,275. People will be seeing like 35,625 over here, right? Oh, there are a lot of sellers. That's why price is going to go down. Sellers are going to push the market down. Let me tell you, these are pending orders. They're not going to push the market down, right? So these are liquidity, which is going to tell the traders that a lot of sellers are there. So which is making the buyers to push the price harder. They're making the job of the buyer who is placing the market order harder, because market orders are the one who is going to move the markets, not the sellers. So market last Friday it went down not because of this big sellers here. Market went down because of this less amount of buyers here. Since we have less amount of buyers, the sellers are easily able to push the market down, whereas any effort they want to take it on the upper side, the buyer effort has to be very huge. So it's very difficult on last Friday for the buyers to take control. Sellers taken control because sellers are easily able to take control because there is not much of an supply of limit orders on the buy side is very lesser. That's what my main point here is. So if you could play the thing, you can see like the 25,150 is the price action by that time. You can see like consistently. Let me tell you, you don't see this. This is a visible quantity. They're not the regular order book quantity. Regular order book quantity, maybe I'll show you later on. It will be in some lakhs of quantity. It is. That's a total volume and total. So this is not total volume. This is like total top 50 depth volume. Total top 50 depth volume is what that's a visible quantity on the top 50 depth. So consistently you can see like most of the liquidity flow, top 50 liquidity contains almost 10% of the market depth. This is only the tip of the iceberg. But the tip of the iceberg shows very interesting patterns, which you can eventually know what is happening in the markets, at least who is in control in the markets, who can gain control in the markets. I can clearly say like sellers can gain clearly control from the markets, not because sellers are more, only because of buyers are lesser over here, right? So as you can see that comparatively, like the ratio is like more than so most of the time it is like more than 1:2. Sometimes we try to match up, but very quickly it goes down. So this is the total bid and ask quantity. Even total bid and ask quantity is like the sellers are more and buyers are lesser. So they are making way for the sellers, but this doesn't matter. Even if there's gonna matching also, for me, what it matters is like the visible quantity of the top 50 depth is what is gonna matter to me. So that clearly indicates that probably one should be looking into the markets, and yeah, so that should be helping what is happening in the markets. As you can see, like price is still at 25,154. Hardly 1 minute has been crossed by. Right? Let me fast forward what really happened later on. This is like after 6 minutes later. Even 6 minutes later also, if you could have seen that the visible quantity is like lesser. So most of the times you can see like 10, 15, 18, and then 34, 46, 50. That's a number you can see over here. More, which means more sellers are there, which is, it doesn't matter, but what matters is like the buyers are lesser. The buyers who are willing to buy, who are not moving the markets, those who are willing to buy are more, and those who are pushing the price down, who are continuously selling in the markets, are clearly down. So you can see like right from the start, the price has been keep going down. Price has been reached like 134 now. Still the pattern haven't changed at all, like throughout the day. This is very dynamic. In a regular market, it will keep on moving also, but that particular day it haven't moved at all. And as you can see, like the over a period of time, the price action has been keep pushing down. The price has been keep pushed down, further down. So it's keep pushing down, but you can see like the pattern has been still remaining the same thing most of the times. Maybe for a few seconds it would have been the buying and selling quantity would have been that being like there will be a change, but eventually it falls back 50 here and then 27, 20 here. And that's the constant number that would have been seen throughout the day. So every pullback on last Friday, right? There was a mini pullback, but still the pattern remains the same, and then price action have to fall down. Price action have to tend to fall down. This is like almost when the price action reached something like around 9:45, which is like half an hour from the day, price fell to 25,106, right? And now we can say like there has been a mild shift is happening over here. Mild shift, not much, but mild shift. It lasted for like some 5 minutes, and then again it fallen back to the original levels. Once again, it fallen back to like some 5-10 minutes. It was there, and again there was a shift. After the price action went down, there was some mild bid and ask. Bid side buyers are more, almost equal, I would say, like almost equal most of the times. As you can see, like almost it's trading more or less equal. And now again it started falling back to the lower levels. Again it started maintaining down below the visible quantity most of the times. You can see like the again 43 here, 20, 22 over here. So again there was a pullback. Every pullback got shorted to the downside. So at this time, if you would have seen that, you don't see much of a variations in the total bid quantity and total ask quantity. What you would have seen is like the variations you would have seen. The visible difference is there in the total ask on visible side quantity, top 50 depth, you will be able to find more difference over here. Right? That is something which is very important to consider, particularly when you are seeing that the context is. I was talking to Vinod. I don't know, Vinod is there or not. Vinod, you're there? We've been talking about like Vinod, I'm thinking that the market is going to go down, like because I'm seeing less demand on the buying side, and market profile confidence is also very high on the short side. So probably it's a good day to short intraday. So he also has its own different idea about it, but from the market depth point of view, what it gives is like it gives a practical insights, and from the execution point of view, you can able to time it out using the order flow charts, right?
Yes, Rajandran, I'm there.
Yeah, so we've been discussing about this, right? So we've been discussing
Yes,
about
yes, yes,
why this market
yes.
depth is
Yep.
showing weaker, and we've been discussing about 50 depth, and we've been me and Vinod are both are practicing market depth for quite some time. But yes, I think in our Trade Edge 8.0 will be 5 different setups. We're going to talk about this market depth very heavily, and yeah, a lot of screen time experience definitely you'll be getting from the market depth point of view also, and we will be the best part is like we can combine market depth along with the order flow charts, right? That is something very important concept that could be the key takeaway for your today's session. So there are two key takeaways for you. One is the market depth. Probably the second one is the stacked momentum setups. Stacked momentum setups, of course, very little expertise is required to watch it and then trade it. Whereas combining market depth, probably a little bit of screen time experience is required. So not just uh, market depth, there are a lot of other strategies also require screen time experience. So what you can expect from TradeEdge 8.0 is like a lot of screen time experience for like almost for like 45 days of learning that you can anticipate, right? At an institutional grade learning is what we do commit in every session. We tend to focus from an institutional perspective how traders can take advantage of the order flow information. So that is something that we will be focusing in our session, right? So what we can grab as the key takeaway from any of our sessions is like what kind of market insight is offered in front of our eyes, and how we can decode that information, and how we can convert that into a trading edge. That's what a trade edge is all about. All right, so I guess Vinod, I think more or less we are done for today's session. Thank you.